Welcome to the deep dive video update. And I feel like I always need to explain what this video is about. I hate the idea of clickbait. You might see deep dive, meaning that we're really going to dive deep and look at some things that maybe other people aren't uncovering. Well, that might be true to a degree, but my context of deep dive is that I have hundreds and hundreds of charts that I look at each day and every week. Not all of them are really speaking to us right now. Some of those charts I still like to show in a video like this because we have to dive deep to see if we can uncover anything about what's actually going on in the market. So that's why I want to explain this. If you thought this was going to mean something else, have a really good day. If you like this idea, feel free to continue on and we'll go through what is happening at the current time. And this is being prepared for Monday, July 15th. I do have a thing called the SPX investing program. It started at the beginning of June. It's still free in July. I'm going to be locking that down in August, and it will be $97 a month once it gets up and going. And there's lots more videos that I post there. There's lots more information. It's a more comprehensive program of what I actually do and teach. I have hundreds of hours of courses that you can go through, and I'll be adding more to that as things get more locked down. If you want to find out more about the program, there are links below this video in the description. There's also a link that can take you to that website. If you want to email me about the program, maybe set up a time to talk, that would be totally fine as well, or just have a back and forth through email that way. This video that you're watching right now is just one of many that I do every week. Around the outside of this circle, these are weekly videos. And I also do an intermarket analysis video. The video that you're watching right now is the deep dive video. After this, I'll be doing what I call the what to watch video. That's where I'm really honing in on what I'm watching at the current time. And then I have a number of supplemental videos. Some of them are on the YouTube or Rumble channel. From this point forward, supplemental videos will only be available on the website for those that are in the program. All of these videos around the outside, they feed into the daily video, which is the real foundation of the analysis that I do. The first chart that we look at is a chart of the VIX. This is for information. I don't really use this to make decisions. This just gives us an idea, okay, what is fear like these days? The VIX is on here, but it's turned invisible. Over top of the VIX is a 50-period exponential moving average, long-term, going back to 2004 over here. And we can see that when the market's really going down, the VIX is in a higher range. When the market's going up, the VIX goes down into a lower range. Then after the COVID plunge, we went into a higher range again, then went back up into that higher range in 2022 as the market was going down. Now we are establishing a lower range with the VIX as things have turned more positive. Another thing that we keep an eye on is how fast is the VIX moving, whether it's going up or down. And I use an RSI based on 9 periods to measure that. We're just about neutral right now. When I usually use this chart in the daily videos is when we get to an extreme positive or negative reading. We also do a number of different studies with the VIX. I really try to hone in on sentiment. What is the market feeling? Are they positive? Are they negative? Are they too positive? Are they too negative? Because we can really use that to our advantage. Another measurement here that I don't use all that often, but I like to look at is the VIX itself, which measures fear. And then there's the VIX of the VIX, or the volatility of the VIX. It's kind of like an indicator on top of the VIX. We look at those in a ratio type of sense here. And typically, when this is going down, the S&P is going up. When this is going up, the S&P is going down. Right now, with this ratio, we are going down, and that's more positive. We also look at the volatility of bonds. That's measured by the MOVE index on top. We look at it in comparison to the VIX, which is the volatility of stocks in the middle area. And right now, we're seeing that volatility in bonds is really picking up. You can see the MOVE index is really dropping, where the VIX really hasn't moved all that much, even though it's giving us very low readings, meaning there's not a lot of fear. And so they're actually having a tendency on a volatility basis to go in opposite directions right now. Then we look at the VIX to move ratio. And as a general rule, when this is going down, that tends to be more positive. Now, we can go up, and this moving average can go up as well. So this isn't a hard and fast rule. But typically, when we see the red line, the moving average going down, that's also positive for stocks. We have been turning back up a little bit, but overall, we've been declining over the last few months, and that tends to be more positive. Then we look at high beta stocks, and these are great when the market's going up because they outperform the indexes like the S&P. And then on the downside, though, they also outperform moving downward when we're going down as well, because they move a lot more than what the market moves. And then we do a ratio with low beta stocks. These are more conservative. They don't move as fast. They might be a little bit more conservative. And we do the ratio between them. When we're going up, that means we're really entering in to a high beta or growth or risk on type of an environment. When this is going down, the market is getting more defensive, meaning that we're going down with the market. Now, we've been chopping around sideways. Earlier in 2024, we were in a higher range. Then we came down and we're setting a lower range. Could we be getting back up into this higher range again, as the market has been doing quite well lately? And just to keep an eye on where are we in relation to the previous all-time high that was set in early January of 2022, we are up 16.53% as of Friday's close, going back to the previous all-time high. Then stockcharts.com, which is where I get all my charts from, they have this thing called technical alerts. And I go through the technical alerts for each day in the daily videos. Well, what you see here, these are the alerts for the whole week. And you can barely read this because I try to scrunch all of these weekly alerts into one slide here. But you can take away from this, when we see an awful lot of red, we're typically going down with the market. When you see a lot of blue or green, depending on what color you see, we are tending to be more positive. And a lot of positive things happened in Friday's session. And then we saw a sell-off going into the close on Friday. So some things turned back to red. So you can just kind of look at this, and just looking at these different colors, get an idea of what's actually happening in the market. Now, another thing that stockcharts.com tries to do for people to help them is they've created this system called technical scores. And you can do this on a stock, on a mutual fund, on an index, on a sector. I use it on different indexes, and I look at 5 main indexes. I look at the Dow, I look at the S&P, which is the foundation of everything that I do. We look at the QQQs, which is the NASDAQ 100. We look at the small caps, and we look at the mid caps. And then we rank them on a score of 0 to 100. The higher the score, the better looking that chart. And coming in first, again, even though it's fallen down a little bit, it's still into the 90s. That would be the QQQs, which is the NASDAQ 100. In second place is the SPY, because there's a lot of stocks in the NASDAQ 100 that are also in the S&P 500. So this has been holding up, but it's dropping below that 90 level. To me, when a chart is really looking strong technically is when it gets a score of 90 or above. But still, for right now, we maintain a positive score with the S&P. Now, what's kind of surprising here is just a few weeks ago, we were below 20 with the small caps. And this is represented by the IWM, which is the ETF for the Russell 2000 small cap index. Well, we might be seeing a shift going on where the small caps could be improving. We saw this thing last December with the small caps doing well. There's this tradition called the January effect, where it usually starts in December, where small caps have a good end of the year and a good beginning. That didn't happen this year. Right when we hit 2024, small caps just stalled, and they've been range bound ever since. Small caps need a lower interest rate environment because they have to have a lot of money that they borrow in order to get off the ground, because they're trying to grow. Well, if interest rates are going to, in fact, start coming down in September, which is the market's anticipating that as of right now. Now, this can always change, but this is just as of right now what the market thinks will happen. That could be more beneficial for small caps. So we're keeping an eye on that. There's a number of different studies that I go through. And if you go back to 2020 into 2021, when we had a really nice up move in the market after the COVID crash, it was small caps that were really leading the way higher. Well, since we bottomed in 2022 and been coming up out of that, small caps have really been lagging behind. So if we're shifting over and staying in a positive environment, but we're seeing a broader market participation, we're going to see an improvement with the small caps and even into the mid caps. So we just want to watch that. But we've been fooled before. It looked like things were getting better, only to have them turn worse again. So we want to wait for confirmation before we actually see this. Then in next place are the mid caps. Now, earlier in the year, the mid caps were actually one of the stronger looking indexes. but then they've kind of fallen on difficult times. But in Thursday and Friday session, we saw a real bump up coming in at 61.9. And in next place is the Dow, which has been doing okay. It's kind of near its all-time high, not doing terrible, but not doing great either. It's coming in under 50 at 46. Then we look at some short-term charts. Now, short-term by what are the moving averages that are plotted here? This is also a long-term chart because I try to have as much price action in here as possible to get a big picture look at the short-term trend. And plotted on here are moving averages from 10 periods up to 50 periods. If you look way up in the right-hand corner, all the lines are going up and prices above all the lines. So the short-term trend is still positive. Then we look at one of our short-term indicators and another up day or two or down day or two, and the Stochc RSI is going to be extreme positive or negative. This tries to take stochastics and the RSI and combine them into an indicator. It's short-term. Once it gets extreme positive or negative, it can stay that way for a long time. But this gives us more of an inkling as what's happening with the momentum. Now, typically, I'll show this in the daily video, but because we're not getting an extreme positive or negative reading, I didn't show that in the most recent video. But if we do get up here, I will be showing it, and then I wouldn't be showing it in this video. And intermediate term, we have another rainbow going from 50 periods up to 100 periods. The lines are going up. As we were pulling back, they started to get a little scrunched up here, but now we seem to be looking at recovering, and price is well above all the lines in this rainbow. This is the intermediate term trend, which still remains positive. Then we look at the 50-period moving average. We're still well above the 20-period moving average, so I haven't needed to show the 50-period moving average here. Price is above both of the moving averages, both a simple and exponential moving average, and the lines are going up. So the intermediate term trend is still positive. The same thing is true here with the 100-period moving average. This is more intermediate to even a little bit long-term, and the lines are going up and price is well above the line. So the even intermediate to longer term trend still continues to be positive. Then we look at a thing called an anchored moving average. This is different from a regular moving average, where if you have a 10-period moving average, you take the last 10 periods, add them all up, and divide by 10. That's a simple moving average, where day 1 and day 10 give you the same amount of weight. An exponential moving average weights things more towards the current price, and then there's the debate that goes back and forth as to which one is better. Don't you think the exponential would be better because it moves quicker? Yeah, I can see that. But tests have also shown that the simple moving average actually performs better because you wait, where the exponential moving average may actually have you doing things. But I plot both of them. Well, on this chart, we have another kind of moving average, which goes to some kind of a high and then shoots it forward. And we're well above the all-time high that was set back in early 2022. And we really haven't had any kind of significant decline. So I haven't added any more anchored moving averages here. If we do, which at some point we will, the market will have some kind of a decline or a pullback, maybe even a correction if we fall as much as 10%. Things were going really good a year ago in 2023 around about this time. Right near the end of July, we ended up declining 10% after that. I'm not saying that's what will happen this time, but everybody was pretty stinking positive a year ago, and then all of a sudden got pretty stinking negative in a hurry, thinking that everything was going to fall apart. So if we do at some point start to see some kind of a pullback, I'll add some more anchored moving averages on here to see if they end up providing support. And we want to measure also how far above are we from the 200-period simple moving average. That's the ultimate line between a positive trend and a negative trend. And right now we're well above it, up into this green area right now. And then this is how much have we gone up. Now, I do these measurements myself, so they're probably not exact. When we set the lows back in October 2023 and been bouncing up, we're up almost 27% from that low going back to October 2023. The mass index is not generating a signal right now. It is when we get up to the red dash line and the blue line. We're far away from that for the time being. The Pring bottom fisher, which I was showing in the daily video because it was generating a buy signal, but we really didn't decline all that much here. We were actually going up when this signal was generated. That's one of the reasons why I don't rely on just one indicator. They all screw up from time to time, and this one obviously was giving us a false signal. But yeah, I mean, it would have been okay. You could have gone for a buy signal here. But the idea behind this indicator is that when we're really going down and we're getting oversold and everybody's pessimistic and sentiment is just in the toilet and everybody thinks the market is pretty much going to crash and burn forever. And then we see a signal from here. That sometimes can be a very valuable signal that maybe we're bottoming and starting to go up. And we look at the percent B indicator. Now, if you look at the weekly chart, we're above this blue line here. Did we close above the upper Bollinger Band? Well, we did earlier in the week as the S&P was really moving up, but since then we've fallen back. So if we have another up day and the Bollinger Band doesn't go up as much and we close up above that, that's when the percent B gives us an extreme positive reading. We make note of that because they don't happen very often, and when they do, they tend to not last very long. And what'll need to happen is some kind of equilibrium will need to take place. Either the Bollinger Band will have to go up, or price will have to come down, or some combination of the two will help work this off from being an extreme positive reading. Now we look at a thing called the Ichimoku cloud, and a lot of people really use these, especially if you trade the foreign exchange market. Really, all these are just some moving averages that are kind of pretty colored and then shifted forward. But this can act as support when we're really going up, when we fall back. When we had that downward move last spring, this ended up providing an area of support for the S&P to bounce up out of. And we're well above the cloud, and the cloud is green right now. So everything is looking positive. So there's been really no need to show this. Now, in conjunction with that is another Ichimoku cloud chart, but this is with a full study, and this actually helps us to determine the trend. When the blue line is above the red line, which it is, we're positive. When price is above both of these lines, that's positive. When the cloud below us is positive, that's positive as well. And then we have a longer term green line here, which is also going up. That's positive as well. So right now, everything in this chart is looking positive from a trend perspective, and we're far away from the cloud, so we're not really using this as any kind of a support area for the time being. Then we have another long-term rainbow going from 50 periods up to 250 periods. This is also showing that the long-term trend still remains intact. So short, intermediate, and long-term, when you measure it by moving averages, the market is looking really solid. Then we take a 10-day average of the S&P 500 highs minus the lows. And for quite a bit in 2024, I showed this chart because when we are really moving up and this is pegged all the way to the top, you could say, okay, that's extreme positive. But that also could suggest very, very good momentum. As we were seeing some weakness, as we were seeing some negative divergences inside of the S&P, we saw this starting to weaken. And it's gaining some strength, but it hasn't come back above this green line yet. If we see more follow through upside for the S&P, this could come back up into this upper area and suggest good momentum. And we have a long-term special K oscillator, and this is long-term because we don't see very many crosses above or below the red line. And when we do see a cross, it tends to last for a long, long time. And this is a daily chart, and we continue to be positive. Then we look at a weekly chart of the S&P on top and a weekly chart of the German DAX. They're the biggest stock market in the EU. But quite often we'll see that the correlation between the top chart and the middle chart is pretty strong. That's when we see a high reading with the indicator down below. Or because they've been having some problems with the French election, and then we just had a UK election, and there's kind of some uncertainty about the US election and what's happening with all of that, we've seen the correlation really dropping off. Now, this probably will come back into line at some point, but right now there's not a strong correlation between the two markets. Then some support and resistance. This is mainly measuring the short term. This is a 20-period simple moving average of the open, high, low, and close. And that creates a mini rainbow, which is kind of cool looking with the different colors here. And the lines are going up and prices above all the lines. This is more for the short term, suggesting that the trend is looking positive. If we start to fall back, one of these lines can often provide a support level. But since we're far away from the lines, I haven't been showing this chart. And we have the possible fib retracements. And the reason I say they're not possible now, they are fib retracements. But if we go back and set another all-time high with the S&P, I'm going to have to adjust this again. That's why I use the word possible. And it's also possible because we haven't seen any kind of a significant decline that's taking us down to this 38.2% retracement level. If we shift and things start to turn more negative, which is going to happen at some point, we're just not exactly sure when. It's a normal thing that markets do. We'll be watching these levels to see if they end up providing support. Then some broad market measures. I was mainly using this last spring when we saw the shorter term 20 period moving average with the QQQs drop below the 50. That was threatening the short term trend at that point. Well, since that time, we've recovered, been able to get above both moving averages, and the blue line crossed above the red line. So now we're seeing, and with the Qs, which is the NASDAQ 100, the short term trend is still intact. Even though we had a down day on Thursday and got some of that back on Friday, we're still well above the 20 period moving average. The 50 period is still going up, and we're above the 200 period moving average. So all the trends are currently still intact with the NASDAQ 100. Then we look at the thing called the Vixen, and you just have to love that name. This measures the volatility of the NASDAQ 100, where the VIX measures the volatility of the S&P 500. And I mainly follow the line chart down here, where we are picking up just a little bit with the fear, as the NASDAQ 100 was actually down on the week for the 5 trading days in this previous week. Then the bank ETF, we did see a move up. Banks came out with their earnings, and some of the big banks reported in Friday's session, and we saw a nice little run up to that happening, only to see the banks decline in Friday's session. But the bank ETF has been recuperating a little bit here. We have a little bit of a doji where we opened, went up, went down, and closed right about where we opened at that point. But we're still looking positive here with the shorter term moving average above the 200 period moving average. We're also keeping an eye on the regional banks because they were really counting on interest rates being cut in 2024. They have a lot of commercial real estate loans. They also have a lot of bonds and a lot of positioning that they've been doing, and a lot of their strategy has been counting on interest rates being cut. They've been really underperforming. And it was a year ago when we saw Silicon Valley Bank and Republic Bank just hit the skids. That's when this ratio went down when compared to the financial sector. Then we started to bounce back up and actually turn a little bit positive. And then bam, New York Community Bank comes out and says, we're having some problems too. And that sent this ratio going back down. We are seeing it trying to bounce up again here. We're just waiting to see. I have a list of these smaller regional banks that could be under some pressure that haven't really caused any problems yet, but we're wondering if something like that is still in the future. I hope not. It'd be nice if everything worked out and everybody was happy and we all could sit around and sing Kumbaya together, but that's not the reality of the situation. So we'll just be keeping an eye on this. Then we look at the S&P 500 and then a ratio between the Qs, which is the NASDAQ 100 and the Dow. And then we measure the correlation down here. And they're having a fairly strong tendency to go in the same direction at the same time. And when they're going up, they're tending to support each other better. And we look at the transports. And this has been a disappointing area too. The small caps and the transports have disappointed folks in 2024. We're starting to come back up a little bit here. That's the red line, but we want to see the red line continue to go up and actually surpass the black line, which is the Dow. I have a number of different charts that we look at. We'll be keeping an eye on this to see if things do improve, but as of right now, we're not seeing much of an improvement. Then we look at the S&P 500 itself as represented by the SPY, that's the ETF, and then do a ratio with world stocks. And when this is going up, that means US stocks are outperforming world stocks. Some rate of change charts, these are just for informational purposes, where we closed on Friday and then it goes back 250 periods. We're still looking pretty good here in this longer term chart, and we're still going up with this other longer term chart as well. Then we keep an eye on bonds, and I show some other charts similar to this, but I typically don't show this one because it doesn't move as much. And so then I show it in this video instead. What I usually show is TIPS, which are Treasury inflation protected securities. And that's what folks want to get into when they're worried about rising interest rates and rising inflation. And that's what we saw back in 2021. These were really outperforming. Then we got into 2022 and they started to underperform. And then we kind of bottomed out here. The problem that we're seeing right now is this ratio is continuing to go back up. We want this ratio to go down. Now, I also follow a 7 to 10 year ratio here, and that moves a lot more. This one is a little more subtle in its movements here, but we want this to continue to fall if the interest rate environment is turning more positive. Then we look at the long-term bond ETF, that's based on price, and we look at the S&P 500. We see that their longer-term correlation is trailing off a bit, but still pretty strong. We also see an improvement in their shorter-term relationship based on 10 periods. And then we look at the QQQs and also with the long-term bonds, and they also have a waning longer-term relationship here, but it's still pretty strong where they're tending to go in the same direction. Then we look at the 10-year yield in the US, and we subtract the German 10-year yield. And because US rates are higher, we get a result above zero. And then we chart the US dollar index down below. And believe it or not, because the game between interest rates and the dollar and international exchange rates and everything, we're actually seeing a pretty strong correlation between the top chart and the middle chart. We'll be kind of watching this to see, is this going down? Is the dollar index, which has been under some pressure this past week, which is actually helping stocks. If these continue to go down and the correlation stays strong, that will end up benefiting stocks specifically in the US. And we keep an eye on the yield curves. It's been over 2 years now since the 10 to the 2, that's the top area, when inverted. It's been about a year and a half, maybe getting close to 2 years, when the 10 to the 3 month went inverted, and it's still inverted. Then I have a couple of other yield curves here that they're not really tracked all that much. It's the top two that are the most important. If we're starting to see some weakness with the employment situation, and the employment situation report, which came out a week ago, was weaker than expected, and this is fueling this idea that maybe interest rates are going to be going down because the employment situation could be showing some weakness. If that ends up playing out at some point, we're going to see these yield curves going back to normal. They're going to both cross back above the red line. And then that's when we start a countdown to see, which is about 6 months or so, to see if we are in fact going to go into a recession. We don't know that yet. We're just keeping that tucked away in the back of our minds for right now. We're just watching things as they play out. We're not making any determinations or any predictions. We're just watching it to see what happens. Then I have a number of things called possible positive scenarios. These are things that I really broke out in 2022 when we were going down, because when we would scream to the downside, these charts would speak pretty loudly to us. And then we would usually bounce up out of that if we saw a lot of convergence in these charts. Well, these charts are also useful on a day in and day out basis, no matter if we're going up or down, but not all of them. And so the rest of the charts I end up showing in this video. This first one is the percent of stocks in the S&P that are above their 200-day simple moving average. Now, I have a different study that I do show every day, but I use it in a little different context. This one I use like an oscillator when we get to an extreme positive or negative reading. Well, right now, we're not there. Also, when we're above 50, we tend to be more positive than negative, and that's what we're showing right now. We're not getting a signal at this point, so I haven't been showing this chart. Then we do a 50-period moving average study with the stocks in the S&P, also using it like an oscillator, either extreme positive or negative. I also have another chart in the daily video that I show every day that is the same idea, but I just look at it in a little different way. We are above 50 right now, so that is also positive. But then to break it down a little bit more, we do that same study with the mid caps, and we're breaking back above 50 after we had been below 50. So we're turning more positive here. We're also seeing a real improvement when we look at the small caps. So things are looking better at this time. We need to see more follow through though. Thank you. I hope you found this video helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.